Arnie, thank you so much. I'm very pleased to be here. Appreciate being invited to be the keynote speaker today. So I'm Eric Hayden. I'm the founder of Urban Catalyst. We are a real estate opportunity zone fund. We're focused on ground-up development and specifically ground-up development projects in San Jose. And today what I'm here to talk to you about is I'm here to give you some information about opportunity zones, tell you about two different styles and approaches to being an opportunity zone fund. The first being developer first, which is what Urban Catalyst is. We are a group of developers that have banded together to form a fund. And then the fund first approach, which is typically a lot of these larger East Coast funds that form opportunity zone funds, raise a bunch of money, and then go across the country looking for developers to partner with. So with that, I want to just start off to talk a little bit about the genesis of opportunity zone funds. Opportunity zone funds were created as a part of the Tax Cuts and Jobs Act of 2017, so that was in December. And really when that happened, nobody knew what opportunity zones were, and they hadn't been designated yet. The first thing that happened is the government said, okay, census tracts qualify as opportunity zones, census tracts with certain income levels. But the federal government didn't want to specify which census tracts across the country would be opportunity zones. They left that up to the states. So as an example, the state of California in April of 2018 selected all of the opportunity zones. They could select 25% of the eligible census tracts in the state to be opportunity zones. And we were very fortunate as developers in the Bay Area, and even more specifically San Jose developers, to have all of downtown San Jose included in that program. The point of opportunity zones is really to funnel money into these lower income areas to generate positive economic activity. And how much money the IRS and Treasury, they stated they think over $100 billion will go into opportunity zone funds. Now, I'm sure a lot of you have read news about opportunity zone funds, and really it's not a lot of positive news. News, of course, inherently loves to talk about negative things, but when it comes to opportunity zone funds, I hear a lot about tax breaks for billionaires. Recently, there was a great article about a property owner. He's a billionaire, he's in Detroit. He lobbied the Treasury to add an additional census tract as an opportunity zone. So that all of his properties were in the zone. He could finance his projects in that way. And of course, that's not what this program is about. This program is really a once-in-a-lifetime opportunity, not only for investors to defer capital gains, but also for lower-income communities to benefit from these dollars coming into their communities to create revitalization. And I'll talk a little bit more about that. So for those of you that are new to opportunity zone funds, let me give you kind of the basics of why investors are interested in investing in them. First off, you have to have capital gains to receive the tax benefits. So everybody that has a capital gains event is eligible. Typically, capital gains events are the sale of stock, the sale of a business, or the sale of real estate. Within 180 days of your capital gains event, if you invest into an opportunity zone, which you can only invest through an opportunity zone fund, you're able to defer paying your taxes for 7 years. So that's through December of 2026. So it's a tax deferral mechanism. The next benefit is that when you pay your taxes in April of 2027, you get a 15% discount. And so for every $100 you would have owed in taxes, you only owe $85. Now, this particular benefit changes on January 1st. It reduces from 15% to 10%. Finally, all of the profits from our fund itself, after our investors' money seasons in our fund for 10 years, all the profits are tax-free from a federal capital gains perspective. And really, that's the big benefit. Our fund plans on generating significant profits from real estate development, and after 10 years when we sell all of our projects, all of those profits are tax-free from our investors. You can imagine that is why people are interested in this program. So what does it take to be an opportunity zone fund? There's a lot of really complicated rules, and if you want to get into the details, my accountant from Novogradux here, you can talk to him. However, I'm going to go through a couple of the high-level rules so that you guys can have, in general, an understanding of what the bigger rules are for us. The first is when money comes into our fund, we are required to deploy that money within 31 months. So the federal government obviously wants to stimulate these lower income areas as soon as possible. And so that's the reason for this rule. But it does make it difficult, as I mentioned, for funds that are not developers, that don't have projects, because they worry about raising money and then having to find projects to deploy that money into within 31 months. It really has been a chicken and egg type of scenario for a lot of these larger funds. The next rule, and this is a more challenging one to describe, but it is we must substantially improve property within 30 months of acquiring it. Now, this is really the rule that has caused Opportunity Zone funds to focus more on real estate, because the whole point of this program was to invest money in business. And real estate took off as a tangent from that because initially the rule said 50% of your income, 100% of your income has to come from inside of the Opportunity Zone. So if you're investing in a business and you think, okay, if you're a bagel shop, then yeah, I can understand how an Opportunity Zone could invest in you. 100% of your income comes from the zone. But what if your bagel shop caters? Then what happens? Or what if you're a flower shop? Heck, what if you're an importer-exporter? What if you're a technology company that sells software? Where you're going to have some problems. So it was very unclear how Opportunity Zone funds could invest into businesses. Now, real estate, of course, my projects that I'm doing, they're in the Opportunity Zone. The project itself is the business. And so that's how real estate took off as Opportunity Zone funds were created. Now, in April of 2018, the second round of guidance came out from the Treasury and the IRS. And they did clarify how Opportunity Zone funds can invest into business. They say now if 50% of the salaries that you pay to your employees, those employees are located in the Opportunity Zone, then that qualifies. Now that's awesome. And I expect to see a lot of funds that start to fund startups, especially in Silicon Valley and San Jose. However, because that only occurred in April and probably took until May for all of the accountants and attorneys to be able to figure out and explain to their clients, and then it takes a while to structure these funds. They're quite a challenge to structure just inherently per the program rules. We find out that yes, there are not a whole lot of funds out there right now structured to finance business. In fact, I've only heard of 2 of them, and I haven't heard of any businesses that they have invested in. Overall, across the market, Opportunity Zones, there's roughly 275 that are active across the United States, and only around 150 of them have raised any money. So that was a little bit of a tangent. So back to substantially improving. And this is how real estate developers do it. We're able to, the rule says we need to put money into a project on a one-to-one basis equal to the value of the structures that are currently built on the land, not including the value of the underlying land itself. So for example, when I go out and buy a project, I do an appraisal. The appraisal says, here's what the value of the structures are and here's what the value of the land is. And all I need to do is put money into that project equal to the value of those structures. Ground up real estate development fits the program great. Or large renovations, it works great. You don't see a lot of folks that are buying existing apartment buildings and rehabbing them with this program because let's say you buy an existing apartment and the units are $200,000 a piece and you're going to be putting $40,000 in per unit to improve it and then flip it. Well, that's not going to substantially improve, so that doesn't work. Larger office renovations and historic renovations have been a lot more common as types of programs this Opportunity Zone funds fund. An example of this, we have a project called the Fountain Alley building. And right now on the project, it's a parking lot and a 2-story nightclub. We're going to be building a 70,000 square foot office building with retail and a rooftop bar. Now, when I got my appraisal, it said the parking lot and the nightclub are worth about $2 million. And because I'm doing construction drawings and paying fees, my construction drawings cost $2 million. My fees are about $1 million. And so in that case, I'm going to substantially improve the property prior to starting construction. So it doesn't mean I have to complete the project. I just have to spend enough money to substantially improve it. Now, the next rule I want to talk about is the 70%. I'm going to call it the 70-30 test. And this is getting down into the weeds a little bit when it comes to the rules, but a lot of the questions I get about opportunity zone funds have to do with, well, how do you qualify as an opportunity zone fund? You know, who regulates you, and how do you make sure that you're not going to fall out of compliance? Because imagine if I fall out of compliance, right now I have 70 investors in my fund, and all 70 of those investors would be required to pay their capital gains taxes this year. Not something they'd be very happy about because they're not planning for. So that would be quite a disaster. So of course I have great accountants, I have great attorneys, I have great fund administrators, but this 70-30 test provides the buffer that makes it a lot easier to qualify as an opportunity zone fund. I have to qualify every December 31st and June 30th, and I register with the SEC, so all of these things go into my compliance categories. The 70-30 test, at the fund level, I have a 90-10 test where 90% of my funds need to be invested into qualified opportunity zone business. Underneath that, as a part of my structure, I have an operating partnership, and at that level, only 70% of my funds need to be invested into qualified opportunity zone property. Now, all of my projects are in opportunity zones. I'm not planning on, say, going out and doing 30% of my projects outside of the zone. What I am planning on doing is making sure that, let's say, I'm not able to spend all of my money within 31 months. I run into some entitlement delays, and I'm not able to substantially improve my property within 30 months of acquiring it. What happens? Do I automatically disqualify? And the answer is no, I don't automatically. It goes into that 30% bad bucket. So it gives you a little bit of a buffer as you continue to move through the process. And eventually, of course, I'm going to substantially improve it, and that project will go back into my good bucket. And then even if I exceed that 30%, then I'm only penalized a small percentage per year from the Treasury and the IRS, and as long as I'm trying to maintain status as a qualified opportunity zone fund, I will. So long story short, it's hard to be kicked out of compliance for an opportunity zone fund. They are a lot more secure than a lot of people think because the rules are somewhat confusing. And hopefully I'm explaining them in a way that you can understand, because I've been to a lot of these types of events where there's attorneys and accountants explaining it, and even though I understand the program, sometimes I get lost listening to them. I know everybody here is familiar with 1031s. 1031's also a capital gains tax deferral mechanism, compared a lot to opportunity zone funds. They're very different types of programs, but it's good to give the comparison. So of course, in a 1031 exchange, you're able to defer paying capital gains almost forever, as long as you buy a property that is more expensive than the property that you've just sold. You're required to roll your basis and your gain into that new property. In an opportunity zone fund, you're able to keep your basis. So let's say you sell a property and you bought it for $1 million and you sold it for $5 million. And let's just forget about depreciation for now. You could take that $1 million and put it in your pocket and only invest the $4 million of profit. And you don't even have to invest the whole $4 million. You can invest $2 million of it and pay taxes on the other $2 million. But it gives you a lot more flexibility. Also, I'm sure a lot of you are hearing from your clients, and for those of you that are real estate investors, that doing a 1031 exchange in California in today's market, the cap rates are extremely compressed. It's hard to find good property to roll into. Let's say you buy a Class A multifamily building and you're looking at a 4 cap rate. It's not a huge return. In an opportunity zone fund, the returns are significantly higher. The national average for internal rate of return that is projected by opportunity zone funds is between 8 and 15%. So that is a lot higher of a return than a typical 1031 exchange rolling into property. Now, of course, most 1031s, you're buying existing assets. And then, of course, in opportunity zone funds, you're buying into real estate development programs. So there is a different risk threshold associated with opportunity zones than with 1031s, and it's important to know that. Wanted to show you where the zones are located here in the Bay Area. Of course, heavy concentration in Oakland and San Jose. Not so much in San Francisco, a little bit. And it's interesting how the state chose the zones. I mean, you think East Palo Alto, no brainer, that'll be an opportunity zone, but it's not. And a lot of the reason for that is when the state sent out notification to cities saying, hey, we're selecting these zones, a lot of the cities just don't have the staff or just didn't pay attention. And so some of the larger cities did a lot more lobbying at the state level to have their census tracts included as a part of the 25% the state was allowed to choose. And that's why San Jose was included. One of my partners at Urban Catalyst, he was able to work with San Jose's Office of Economic Development, lobbying the state government to have all of downtown San Jose included. San Jose received 11 census tracts, 4 in their downtown area. Arnie mentioned that it's the largest opportunity zone. It may not be the largest opportunity zone in California, but it's definitely one of the best opportunity zones in California. As the only urban environment in Silicon Valley, or true urban environment, it really has a unique potential that a lot of other opportunity zones don't have. And so I'll talk a little bit more here about San Jose real estate and why we looked into San Jose as an opportunity zone fund. When we look at San Jose, we want to look for the 3 things that I look for when I do ground up development anywhere. Because it's really important to note, investing in opportunity zone funds, it's not about the opportunity zone program necessarily. It's about the underlying real estate. It's about being a good real estate development company. The opportunity zone benefits, they're just the icing on the cake. I mean, if you think about it, if there are no profits after the end of 10 years, really what's the point of the program in the first place? So looking at opportunity zone funds, if you're doing business with any out there, be sure to make sure that those groups have great underlying projects and that it isn't just about the program, because the program itself is nice, but it's not the end-all be-all. So when we look for real estate development projects, the first thing we look for is demand. We want to make sure that the types of buildings that we're building have people that want to lease them, live in them, work in them. So, of course, in Silicon Valley, we have large tech tenants. California has a housing crisis. Zoom, Google, Adobe, they all add to the demand that drives a variety of different project types. The next thing we want to see is existing transit and physical infrastructure. These are important. You know, San Jose International Airport, fastest growing airport in any major city in America. BART recently funded to come to downtown San Jose after 62 years in existence. BART's scheduled to be operational in 2030, and boy, we are pleased that after all of this time, San Jose will finally get BART. Caltrain, of course, goes to the Diridon Station, which is the largest multimodal station on the West Coast, and that's where, of course, Google has purchased all of their property recently right around the Diridon Station. Also want to mention San Jose State, 35,000 students. It's the second largest university in the Bay Area behind Cal. And San Jose State has a unique fact that Apple and Google hire more engineers from San Jose State than any other college in the world. The last thing, and probably the most important thing to look for in a city as a developer when you want to do business, is local government policies. Everybody knows in California it is a real challenge to get entitlements and building permits to build any type of development. CEQA has become just an obstacle that is very difficult to get through. In downtown San Jose, they really know that there is a problem in San Jose, or in a problem in California with the entitlement process, and they've streamlined the entitlement process. If you think in California, in my experience, it takes 3 to 4 years from when you submit your initial application to when you get your building permit. In downtown San Jose, they've streamlined it to 12 months. There's no planning commission approvals, no city council approvals. Your developments, even high-rises, are approved with a staff level approval. And CEQA has been done at a programmatic level for the entire downtown area, so that you can just really ride the coattails of that CEQA approval that is built-in allocations for a variety of project types: retail, office, multifamily, you name it. So it's really a great place to do business. And as an opportunity zone fund, I need to make sure that I can start doing these projects as soon as I can. I can deploy all of my money. So I'm not going to go looking to do projects in cities that have longer entitlement processes, which is almost every single city in the Bay Area. I like talking about Bay Area home prices. All of you are probably familiar with this. I mean, obviously we're in a housing crisis. It's a supply and demand issue, and Silicon Valley is one of the most expensive markets in the nation. And as a developer, I'll just say this one thing about the housing crisis. People talk a lot about how we need to have more affordable housing. It really has become the political hot button thing to say. We need more affordable housing. Well, obviously we need more affordable housing, but we need more housing, period. We need so much housing. We haven't built enough housing to meet the demand from the jobs that are created in Silicon Valley in 35 years. Here's an example of the housing gap. As you can see, it's not decreasing, it's increasing. We're creating even more jobs per year than we are building houses. And this is why you see a lot of the state legislation coming through right now saying, well, we're going to take land use authority away from local governments and put it in the hands of the state. The first successful bill was SB 35, which of course is being tested at the Valco Mall in Cupertino with Sand Hill Road. I'm sure a lot of you are following that in the news. But there are other bills right behind it. One that almost passed last year, SB 50, would have allowed 5-story construction on any major transit line anywhere, and 8-story construction within a half a mile of any major transit stop. And that's just period. No CEQA, no entitlements, no city council. You can just get to go pull building permits or you can sue the city. And that didn't pass, but it was very close. Something like 36 bills were proposed in the state legislature this year to address the housing crisis. And you're just going to see more of this because the cities have been listening to the neighbors. And you can't really blame them for that. The neighbors show up, and especially in smaller cities, you have these city council members who are elected by, a majority of 300 votes. And if you have a controversial project and 100 people show up, you're not going to be reelected. You're walking the plank every single time you're looking to approve a project. So of course you can't approve the projects. And that's why you see our building permits not moving as fast as our jobs are being created. And that's why you see housing prices going through the roof. Now, will the local governments listen to the state government and solve their own problems, or will the state have to come in? That's a drama we get to watch unfold over the next couple of years. Also want to talk about office and the office market and Silicon Valley in general. Silicon Valley has always been awesome, but right now what's happened in the last decade is the largest tech tenants, the largest technology companies have just gotten bigger. And they've gotten bigger to this enormous size, and that's really affecting how the office market has changed in Silicon Valley and San Francisco. So right now, Google takes 95% of the office space in Mountain View. Apple has 85% of the office space in Cupertino. Facebook and Google combined have over 50% of the office space in Sunnyvale. You can see growing out of Mountain View and Palo Alto, those are small cities that are the center of the technology universe. Of course, they have $10 per net square foot rents per month. That's pretty intense. So you see a lot of technology companies have gone to San Francisco. And you can see them, some of them have gone to the East Bay, and then a lot of them have been moving southward. Everything off the 237 in Sunnyvale is now built out. Santa Clara is trying to build some stuff. They don't have a lot of places to do it. Campbell has almost nowhere to build. And as an opportunity zone fund looking to do ground up development, where's the next stop for all of these large tech tenants? And the answer is downtown San Jose. And that's why we're focused on that area right now. You can just see how much tech job growth there has been in the last 10 years. And you can see the story of San Jose. Office rents in 2012 were $2.50 a net square foot, and there was a greater than 29% vacancy rate. And now office rents are $5.50, and there's less than 5% vacancy rate. This is how the migration is occurring. And downtown San Jose, that has been overlooked for the last 60 years, has suddenly become the hotspot for new development. I'm going to skip through this slide and go to this one. Just want to talk a little bit about recessions. People are always asking, how do recessions affect opportunity zone funds? And I like to say opportunity zone funds are recession resistant. They're a longer time period than typical real estate equity funds. We have over 10 years to do business. Most real estate equity funds are focused between 3 and 7 years. They want to get in, improve, flip. They want to get in, put in a new tenant, and flip. That's their business model. Opportunity zone funds, it's a longer term hold play. It's almost as if we have a value add fund followed by a core fund. Recessions, of course, affect everybody. Now, they especially affect us when it comes to financing our buildings. We're going to go out and use leverage on all of our projects. We have 7 projects. All of you can come and talk to me about giving me a construction loan on one of my 7 projects in the next 12 months. Our construction loans, we're looking for somewhere between 50 and 70% loan to cost to build our buildings. And if our appraisals don't come in right 2 years from now or a year and a half from now when we're going out and getting financing to build these buildings, we could have a problem with building all 7 of our projects. So that's one place that we have a sticking point. Now, I'm hopeful the economy lasts for another 18 months so I can get all my projects under construction. Another point where we have a sticking point is when we get refinance events to occur. Refinancing our projects when they're stabilized, of course, we're going to take out our construction loan, but new legislation as a part of the clarification of the April guidelines that came out regarding Opportunity Zone funds, it says that we're able to distribute those proceeds of our refinance events to our investors tax-free, up to the amount that they initially invested. At Urban Catalyst, we're looking to return 75% of our investors' initial investment back to them within 5 years of investment. So that was a big change in the program. You don't have to hold your money in an Opportunity Zone fund for 10 years. You get money out earlier. And that, of course, helps the internal rate of return. But this shows, from a multifamily perspective, how recessions have affected the asking price for rents. You can see in 2000, 2001, the dot-com bust, massive decline. But then, it's interesting, you look at the greatest recession of our lifetimes in 2008 that especially hit real estate hard. How come rents didn't go down more in that recession than they did in the dot-com bust? And really the answer is the tech companies in Silicon Valley and the jobs that they've created really buffered Silicon Valley from that crunch. In 2001, internet companies were like pets.com and smartphones weren't invented. So you can really think about that when you think about how the different recessions have affected the valley and how Silicon Valley and the Bay Area in general is a very recession-resistant place and great place to do real estate investment. In downtown San Jose, there's a lot of articles about the Google effect. So Google in the last 12 months has come to downtown San Jose and purchased $400 million worth of property near the Diridon Station area. They just submitted their plans to the city 2 weeks ago. And their plans said they're going to build somewhere between 7.5 and 8.5 million square feet of office, 5,500 residential units, and some associated retail and parks. They're estimating that 35,000 people will work in this new campus that they're building. And they say, oh, great, this Google's going to have a massive effect on San Jose. And I look at it a little bit differently. I look at it more that Google is the effect of a solid fundamental real estate market in San Jose. The reason they came here, say different than Amazon in New York. Remember Amazon looking across the country, who's going to give us the most tax breaks? Who's going to give us the best deal? Yeah, when Google wanted to come to San Jose, the mayor of San Jose said, and if you're going to come here, you're going to build more below market rate housing than is required by the city. They didn't give them giveaways, they gave them extra penalties. And they still came to San Jose. It's not just because they're out of space, it's also because they realized in their surveys of their employees that a lot of their employees live in San Jose. San Jose traditionally has been a bedroom community. If any of you ever do the drive from San Jose to Mountain View or find yourself stuck in the traffic that I was stuck in this morning on the way here because I live in San Jose, it takes about an hour and a half to go 15 miles. And it used to be cool in the early 2000s. Google had buses. Those buses had Wi-Fi, amazing. Yeah, Wi-Fi and buses really isn't a draw these days. Google wanted to be close to transit. They wanted to be close to their employees, so it made very logical sense for them to be in the downtown area. This shows another graph of when Google is planning to come to San Jose, matching that up with the Diridon Station improvements, the electrification of Caltrain coming up here to the city, and BART coming to town. And then, of course, in this slide, which always makes everybody groan, high-speed rail's estimated timeline to come to Diridon Station, if that ever happens. This is just a quick example of the BART extension. Right now it goes to Warm Springs. At Urban Catalyst, we have 2 projects that are 100 feet away from the new BART stations, true transit-oriented development. That's really what we look to do. And then I wanted to give you a deeper dive into San Jose real estate. So that purple area, that's where Google has purchased all of their property. The Diridon station is located there just to the left. The black line represents the opportunity zone. So you can see Google didn't even come into the opportunity zone. They just bought property in San Jose because they wanted to be in San Jose. Inside of the opportunity zone, you can see where Adobe's headquarters are. Adobe, of course, has been the largest tech tenant in downtown San Jose for 22 years. They have over 1.2 million square feet of office and 3 towers. And they're currently under construction on an 850,000 square foot office tower. It'll be the first tower completed in downtown San Jose, office tower, in almost 10 years. Now, this is just to show you the development opportunities. These yellow boxes, these represent what we see as ground up development opportunities in downtown. So you can see there's a significant number of opportunities. One that's great to point out right across from Adobe there, that large yellow block, that's called City View Plaza. City View Plaza was purchased by San Francisco developer Jay Paul recently for $283 million cash. Right now it's a 600,000 square foot office retail complex. It has 2 high rises on it. And Jay's plan is to demolish all of the buildings, including the high rises, and build 3.5 million square feet of office. So pretty significant. In fact, Jay's purchased 3 properties in downtown in the last 6 months, spending almost $650 million on acquisition. Jay, of course, has built almost 11 million square feet of office in and around the Bay Area in his career. His latest was Moffett Fields, where he has Amazon and Microsoft now. So our business plan, of course, at Urban Catalyst, coming in and purchasing land now, now we have other larger players that are really following our trend and proving out our model. These are properties that Urban Catalyst acquired in our target acquisitions. And these blue projects are projects that we've acquired. We really have acquired a diverse set of projects, everything from office to hotel, multifamily, student housing, senior living. And again, it's about doing projects. It's about the underlying real estate. It's not about the Opportunity Zone program. Now, the Opportunity Zone program is nice. You get great benefits from it. And yeah, it gets a lot of press out there in the world. But it's not all about the tax breaks. Now, one thing I wanted to point out, I don't know if any of you read the article about Steve Scaramucci that came out this week. Steve Scaramucci is my favorite example of a large East Coast fund that announced they were going to raise $3 billion in the Opportunity Zone program. And he just revised his fund target to 10% of his original size, citing that nobody is investing in this program. There's absolutely no demand. Now, I can tell you firsthand, there's a ton of demand for this program. But the problem is that almost every Opportunity Zone fund out there is a startup, and a lot of them are not professional. I'd say almost 70% of them really don't know what they're doing. There are good groups out there, of course, like Urban Catalyst, but there are a lot of people that you need to stay away from. It's hard to tell. It's almost, you could relate it to, the hemp industry, legalizing marijuana. What is out there in the world in that industry? It's a lot of people are doing good work and a lot of people are not. But as time has gone on, things have really sorted themselves out, especially with the April guidelines and clarifications that came out. Those guidelines really made a huge difference in our fundraising and really solidified in investors' minds that there's no more confusion surrounding the program, that it is a thing that you can invest in. These are some examples of the 7 projects that we're doing at Urban Catalyst, just so you can see the variety of project types we're doing. I won't go into a lot of details about it because I want to get to the timing that I talked about regarding Opportunity Zone funds in a little bit more detail. So we're planning on raising money in 2019 and 2020. There's a lot of myths out there that this program is going away. I'll tell you the one thing that this program will have is that investment into Opportunity Zone funds, as long as you invest prior to December of 2026, you can still get the tax-free profits after 10 years, the biggest benefit. So there will be investment in this program at least for another 6 years. The best benefits, of course, are in the first 2 years or in the first 4 years. Of course, the first 2 years of the program ends here in a month. So because of all the confusion associated with it, we've missed out on the first real 2 years of the best benefits, but it's not too late. There is another couple years where this program really works. This is where we do our refinance and distribute to our investors, just showing that our investors are able to get money back before the end of a 10-year period. And then, of course, this is where we liquidate and return all of the profits to our investors. And I'm going to skip through my example here. I just want to say thank you again for having me as your keynote speaker. It's been my pleasure to talk to you about Opportunity Zone funds, and I'll turn it back over to Arnie.